Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a recent report that highlights a growing trend among Canadians turning away from the condo market, especially amid what's being termed the Toronto crisis. With nearly one-third of Canadians now viewing condos as a diminishing investment opportunity, it's clear that the landscape is shifting. Janine, what do you make of this?
Well, Steve, it's certainly a complex situation. The report from Rates.ca shows that only 11% of Canadians would consider buying a condo as an investment, while more than half wouldn't purchase one at all. That's quite significant. It seems that the oversupply of condos, especially in cities like Toronto and Vancouver, is a primary concern. What are your thoughts on the numbers?
The numbers reflect a real challenge. Kevin Wong from Swivel Mortgage Group points out that while prices have stayed stable, the high inventory and subdued sales are dampening investor interest. This oversupply is particularly pronounced in urban centers, and it's been building up over the years. Frank Clayton from Toronto Metropolitan University even mentioned that we've overproduced condos since the late 1990s. It's a stark reminder of how market dynamics can shift over time.
Absolutely, Steve. And it's not just the oversupply that's affecting investors. The report highlights that falling resale values and rising borrowing costs are making it difficult to achieve positive returns. Investors are facing monthly losses of $500 to $700, which is a significant jump from previous shortfalls. This is causing many to reconsider their investments or look for more profitable options.
That's right, Janine. Devell Morrison, a Toronto-based real estate broker, noted that the math for investors just doesn't add up like it used to. And with rental returns cooling, average asking rents in Canada decreased by 2.8% year over year in March. It's clear why investors might be looking elsewhere. Rising carrying costs are adding to the burden, prompting divestment or a shift to other markets.
Interestingly, though, there's a glimmer of hope among younger Canadians. The survey found that 28% of those aged 18 to 34 still see condos as a viable investment, mainly because they view them as an affordable entry point into the housing market. This optimism is heartening, though affordability does vary widely across the country.
Indeed, Janine. Calgary and Edmonton are more accessible, offering significant income surpluses for buyers. But in places like Vancouver and Toronto, the barriers are steep. For example, in Vancouver, the average condo price requires an income of $182,000, which is quite a bit higher than the median family income. Experts suggest we might see further price declines before any recovery, especially if current conditions persist.
It's an evolving situation, Steve, and it will be interesting to see how it unfolds. For those considering entering the condo market, it's crucial to weigh these factors carefully. As always, staying informed and understanding the market dynamics will be key in making sound decisions.
Let's delve into the housing plans being presented by the two major federal parties in Canada. The Conservatives, led by Pierre Poilievre, and the Liberals, under Mark Carney, have laid out distinct strategies to address the ongoing housing crisis.
That's right, Steve. The Conservatives are proposing a rather aggressive approach. They want to tackle municipal delays by penalizing and overriding municipalities that slow down housing projects with excessive red tape and fees. Pierre Poilievre is advocating for a target of 15% housing growth annually for municipalities, with federal funding tied to their progress. Cities that meet or exceed these targets would receive bonus funds, while those that fall short could face funding cuts.
Exactly, Janine. Poilievre is also suggesting financial penalties for local governments that obstruct housing developments due to NIMBY protests. He believes that by encouraging private sector construction and selling off 15% of federal land for private affordable housing projects, the market can be invigorated. This approach contrasts sharply with the Liberals' plan.
Indeed, Steve. Mark Carney is proposing a more traditional approach by opening a government development agency called Build Canada Homes. He's planning to seed it with $25 billion in financing, aiming to double Canada's housing output to over 500,000 homes per year. Carney is looking to draw from past strategies used post-Second World War to build affordable housing across the country.
Carney's plan also includes utilizing prefabricated construction and boosting the existing Housing Accelerator Fund. He argues that this method will provide a more sustainable and large-scale solution to the housing crisis. Both parties are pledging to cut the goods and services tax for first-time home buyers, but with different maximum purchase price caps, $1 million for the Liberals and $1.3 million for the Conservatives.
And let's not forget, Steve, the federal New Democratic Party and the Greens also have ambitious housing plans. The NDP is looking to set aside federal land for 100,000 new rent-controlled homes and provide publicly backed, low-interest mortgages. They also propose to triple the existing Housing Accelerator Fund. Meanwhile, the Greens aim to triple Canada's housing stock within 7 years and cap housing costs to 30% of income.
It's clear that each party is taking a unique approach to address the housing issue. The Conservatives are leaning heavily on private sector involvement, while the Liberals are focusing on government-led initiatives. The NDP and Greens are pushing for more radical changes. It's going to be interesting to see how these plans resonate with Canadians and how they will impact the housing market moving forward.
Steve, let's talk about the recent launch of Mortgage Brain AI, a new platform that's making waves in the Canadian mortgage and debt solutions market. It's been introduced under Matrix Mortgage Global and aims to provide more accessible and personalized financial solutions using artificial intelligence.
Absolutely, Janine. This platform is quite interesting because it combines AI with licensed guidance to help homeowners navigate their financial futures. According to reports, there have been over 101,000 insolvency filings in Canada in the past year, which is a clear indicator of financial strain. Mortgage delinquencies have also risen by over 50%.
That's quite concerning, Steve. Many homeowners seem unaware of how they can leverage their home equity to reduce high-interest debt and improve their cash flow. Mortgage Brain. AI is stepping in to fill this gap by analyzing clients' credit profiles, income, and equity to provide tailored financial options. It's a proactive approach to a growing problem.
Exactly, Janine. The platform doesn't just stop at refinancing options. In complex financial situations, it refers clients to a national network of licensed insolvency trustees and financial professionals. This ensures that homeowners explore all potential avenues, including consumer proposals or even bankruptcy if necessary. It's about giving homeowners a full spectrum of options and not just a one-size-fits-all solution.
Josh Coos from Mortgage Brain AI mentioned that the platform was created to remove the guesswork and stress from the mortgage process, especially for those feeling overwhelmed. It's about using technology to provide a clearer picture and help clients take confident steps forward.
Right, Janine. And in today's high-interest environment, there's a growing demand for transparent, tech-enabled financial guidance. By aligning AI insights with licensed human expertise, Mortgage Brain AI helps clients understand and act on their options, whether that means refinancing, restructuring, or exploring other regulated paths.
It's certainly a timely introduction, Steve. With Mortgage Brain AI operating under Matrix Mortgage Global's FSRA license, it ensures that all advice and services are delivered under the right regulatory oversight. This is crucial for maintaining trust in such a sensitive industry.
Definitely, Janine. With more than 15 years of experience across the UK and Canadian mortgage sectors, the founders are well equipped to deliver practical outcomes for individuals facing debt, equity, or credit challenges. It's a promising development for Canadians looking to make smarter financial decisions. Now let's turn our attention to some concerning economic news. According to a recent report by Oxford Economics, Canada is expected to face a deeper recession than previously anticipated. Despite some reductions in tariffs between Canada and the United States, the economic outlook is clouded by weaker global demand, trade war uncertainties, and job losses.
That's right, Steve. Oxford Economics has downgraded Canada's GDP forecast, predicting only 0.7% growth in 2025 and a contraction of 0.2% in 2026. This is quite troubling, especially since the effects are expected to hit exports and business investments the hardest. The report also mentions that job losses, rising costs, and asset price declines could squeeze household disposable income, affecting consumption and housing.
Exactly, Janine. It's a complex situation. Tony Stillo, Director of Canada Economics at Oxford, highlights that even with lower tariffs between Canada and the US, higher tariffs on other countries imposed by the US could weaken global demand, which in turn impacts Canadian exports and investments. It's a domino effect that we need to watch closely.
And let's not forget the human aspect, Steve. Oxford's forecast indicates a peak unemployment rate of 7.7% in the second half of 2025, with about 200,000 jobs potentially being lost. That's a significant impact on families and communities across the country. The housing market is also expected to feel the pinch, with home prices projected to fall by 8% to 10% by mid-2026.
The report also talks about inflation dynamics. While the removal of the federal carbon tax and lower global oil prices might temporarily push inflation down to 2%, it's expected to rise again to 3% by the end of 2025. This fluctuation could influence the Bank of Canada's monetary policies.
Inflation is indeed a tricky issue, Steve. Oxford Economics suggests that the Bank of Canada might hold its overnight rate at 2.75% through 2027, despite the recession. This would be a departure from previous cycles where rate cuts were more common during downturns. It's important for Canadians to stay informed and plan their finances accordingly.
Definitely, Janine. The report also projects a gradual rise in 10-year government bond yields and a stabilization of 5-year fixed conventional mortgage rates above 5%. This means borrowing costs could remain elevated for some time, impacting both consumers and the housing market.
It's a challenging environment, Steve. For those navigating mortgages or considering home purchases, these insights are crucial. As always, it's important to stay informed and work with trusted professionals to make the best decisions.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.